Hi everyone, welcome to the final unit 6, and we'll talk about budgetary planning and responsibility accounting in this lecture. The objectives are pretty straightforward. We'll learn how to better understand the master budget and to prepare different types of budgeting. And in the back end of the lecture, we'll talk about static and flexible budget reports. So let's go on to the first one. What exactly is this budget? Well, generally speaking, it's a written statement of management plan for a specified future period, which is usually expressed in financial terms. And the key thing to understand here is that it's basically used as a control device and to promote efficiency within the organization. Now, if you look at your uh, textbook very closely, you will learn that historical accounting data on revenues, costs, and expenses helps in formulating future budget goals. So, we can refer to this as using historical data to benchmark and to forecast our budgeting goals in the foreseeable future. And management, of course, need this information in order to plan, direct, and control the company according to their long-term objectives. What are the benefits? Well, again, these are pretty much straightforward for anyone who has been in an organization. Basically, it helps you to plan ahead. It defines the objectives or your planned objectives. You can also use budget to as a warning system for potential problems, coordinate activities, greater management awareness as far as the entity overall performance or operation is concerned, and from a human resource perspective also, or from a compensation perspective, how it motivates individuals within the organization. The essentials of effective budgeting has to do primarily with how your organization is structured. So a sound organizational structure with clear boundary demarcations in terms of authority and responsibility should be clearly defined. And this should be based on research and analysis. I would expect that most companies would have these two in place, strategically in place, based on advanced research and analysis within the company. The budgeting process is quite straightforward. So you will collect your data, you collect as much data as possible for various months and units. Then you will want to make sure you prepare what you want to prepare before the year end. The key here is that you're trying to forecast into the near future, and so you need to understand, and here you're getting into really advanced analytics really to forecast sales. And if you are a publicly traded company on the stock market, you want to make sure that your shares are being represented well on the stock exchange in terms of the daily or weekly fluctuations. The budgeting process, as you can see here, involves a lot of conditions when it comes to sales forecasting. So we must take both internal micro and external macro conditions, economic conditions, as you can see here, industry trend backed by market research studies, based on advertising and promotion. Again, as I've said, you have to look very closely at previous market shares or benchmarking or historical data. It changes in prices over time, and also most important at this point in time, how technological developments probably will influence your budget going forward. The master budget is basically made up of two classes: the operating budget, that is, this results in the preparation of the budgeted income statement, and then your financial budget, in which you list your capital expenditure, your cash, and your budgeted balance sheet. So here's an illustration of what those are. We will go through the sales, production, direct labor, selling, admin, budget in the next couple of slides. So let's look at some of these budgets. The first one is a sales budget. So basically this budget is about estimating sales for the foreseeable future. And the first example here is pretty much straightforward really. You have a company that have expected sales in quarter 1 of 3,000, and the sales increases every quarter by 500 as you can see here. But the price is stagnant throughout the 60 units. So your sales budget basically is you take your expected sales times your unit selling price for each quarter, which will give you your total sales at the end of the year. And then we move on to the production budget, which flows directly from the sales budget. So again here the formula is you want to determine the required units that you need to produce. So you take your expected sales plus your desired ending finished goods inventory minus the beginning finished goods inventory, which will give you your required production in units. And so if we use the sales data from before on the previous slide, please make an optical note of this. We can easily calculate it. So the question is saying that you're using the same sales data, but now you want ending inventory of 20% of the next quarter budgeted sales. So here, as you can see, for quarter 1, we have 3,000. 20% of the next quarter sale is 700. So our desired ending finished goods inventory is at 20%, which is 700. You do the math, our total unit production is 3,700 less the beginning inventory. Again, you have to take out, as you can see here, 20% of estimated first quarter of 2022 sales, okay, which is 600. That will give you 3,100, and you do the same thing for a quarter 2, quarter 3, and quarter 4, and so on. Now in terms of the direct materials budget, it's a few formula here that you would have to not memorize but try to understand. To show the quantity and the cost to be purchased, you first take the unit to be produced plus the direct materials unit per unit of unit produced, which will give you the direct material unit required for production. And this is all very much represented in your textbook. And to get the direct materials to be purchased, you take your direct materials unit plus your desired ending direct materials again per unit minus the beginning direct materials per unit, which will give you the desired direct materials to be purchased. And in terms of the direct materials unit to be produced, the formula is basically similar, slight difference. You take your direct materials unit required for production plus your desired ending direct materials unit minus the beginning direct materials unit, which will give you the amount to be purchased. And then the formula for the cost is the direct materials unit to be purchased times the cost per unit, which will give you a total cost. So let's work through one using this formula. So you can see here, just take a minute to read the question, please. Alright, so each unit produced requires 2 pounds of raw materials at a cost of $4. This is the key. The company maintains an ending inventory of raw materials equal to 8% of the next quarter production, and the desired ending direct materials amount is 1,020 pounds for the fourth quarter of 2022. So we asked to use this information to prepare a direct materials budget. So as you can see here, the units to be produced is the same from the sales data, quarter 1, quarter 2, quarter 3, and so on. The direct materials per unit, as we have seen in the question, is $2. So total pounds to be produced, let's do quarter 1 is 3,100 times 2, which will give you 6,200. Your ending direct materials is that percentage that we talked about. Sorry, I got to go back here. Is that percentage that we talked about previously here? So that will be your 720. So 10% of 7,200, which will give you do the math again, that will give you 6,200 plus 7,720 will give you 6,920, less your beginning inventory of 620, which will give you direct materials purchase of 6,300. And as I have said in the final part of the formula, you basically take the direct materials to be purchased times the cost per pound, which will give you 25,200. So again, I strongly urge you to please read through the chapter on this part here to get a better understanding. And then moving on to the direct labor and manufacturing along with the selling and admin budget. Here we're talking firstly about the direct labor budget, and the formula for that is units to be produced, very simple, times the direct labor hours times the labor cost, which will give you your direct labor. And that's again very straightforward. So here we have the units to be produced is in quarter one, quarter two, quarter three, and so on. For quarter one, it's 3,100 times the number of labor, so labor hours. So here it's 2 hours. The total direct labor hours would be 3,100 times 2, and you do that for all the quarters, times the direct labor cost per hour of $10, which will give you $62,000 for quarter one in terms of direct labor expense. So nothing really difficult here about the math, but it's a contextualization of this that we will expand upon in the management accounting course in the master's program. And then for the manufacturing overhead, again, just look at here, we're basically talking about variable and fixed costs. So let's go through the question. Hayes Company expect variable costs to fluctuate with production volume. And they've given us indirect materials as $1, indirect labor 140, utilities is 40 cents, maintenance is 20 cents. Thus, for the 6,200 direct labor hours to produce 3,100 units, as we've seen previously, budgeted indirect materials are 6,200 times 1 indirect labor, 6,200 times 1.40. So this is just examples that they're giving you here. Moving on here, Hayes also recognizes that maintenance costs are fixed. So this is the key. The key here is that this amount, the fixed costs, is all assumed. Okay, just keep this word in mind, assume. The fixed cost is all assumed, so they want us to prepare the manufacturing budget. Now you go back to the question. I don't want to move back and forth here, but just for optical purposes, we are being told we have the number of units. We have calculated this previously for each quarter, and all you do is a straightforward calculation. So in terms of your variable cost, you take 6,200 times indirect materials of 1 hour times indirect labor of 140, which will give you the corresponding amount. We have calculated this in the previous page as an example. Utilities 40 cents times 620, 6,200 will give you 2,480. Maintenance 6,200 times 20 will give you 1,240. So we have a total variable cost of 18,600, and this is all our fixed costs. Now, as I have said in the previous slide, let's assume these fixed costs are fixed. So you add 20, 3,800, 9,000, 5,700. You have a total fixed cost of 38,500 plus 18,600, which will give us 57,100. So our total cost for the entire year, total manufacturing cost, is 2,446 divided by our total labor hours of 30,800, which will give you our corresponding amount. Now, moving on to the selling and administrative expenses here. This is basically a projection of your anticipated expenses, and it's very important to distinguish between what's your fixed and what's your variable cost. So let's go back to this question here. Our variable expenses per unit of sales are sales commission $3, freed out $1. Variable expenses per quarter are based on unit sales from the sales budget in the 15.3. And Hayes expects sales in the first quarter to be 3,000 units. Again, let's assume that fixed expenses are based on an assumption or assumed data. So prepare our selling and admin expense. Here we go again. Nothing different really. So our budgeted sales are this amount. The variable cost is what they've given us. So 3,000 times $3 of sales commission is 9. 3,000 times $1 of freed out is 3. So variable cost is 12,000, and our fixed selling and admin costs are, again, these are all assumptions. So advertising is 5,000, sales 15,000, and so on, for a total of 40,000, 30,000 total fixed selling and admin costs. So in total, our variable plus our fixed selling and admin cost is 42,000. Now let's move on to static and flexible budget. The important thing to note here in summary is that the static budget is fixed. You cannot go back and change it, right? Whereas a flexible budget is something that is flexible. You can't go back and change it. And the key thing to understand here is this. So the static budget is a projection. It's a projection of budget data at one level of activity. This key word here, one level of activity. So when using budgetary control, each budget includes the master budget. Each budget included in the master budget is considered to be static. So again, the key is to understand that with a static budget, we're dealing here at one level of activity. And the bottom line is, at the end of it, when you calculate your budgeted and your actual budget, you're basically deciding whether your difference is favorable or unfavorable, as you will soon see. So let's look at an illustration. The budget and actual sales data for right tribe product in the first and second quarter of 2022 are as follow. Budgeted first quarter 180, actual 179. So as you can see here, we budgeted more than the actual amount, so we have a difference in the first quarter of 100. Second quarter we budgeted 210, our actual was 199, and we have a difference of 10,500. So in total for the first and second quarter we budgeted 390, but we actually came in at 378 in sales. So because it's sales, our sales is less, this 11,500 would be classified as an unfavorable difference. Okay, we always want sales to be higher, right? So if this was higher, if this was, let's say, if we flip this around, if 378 was budgeted and 390 was actual, then this would have been, assuming this is higher, then this would have been a favorable amount. So again, moving on, as you can see here, what I was talking about in the first quarter, we have just looking at the first quarter, we have a budgeted amount of 180, our actual amount of 179 in sales. So therefore we have an unfavorable difference. As I have said, let's say budgeted was 179, actual sales was 180, we would have had a favorable difference. Okay, and so the same thing goes for this total sales for the second quarter, right? The total sales for the second quarter, as you can see here, would be unfavorable. And then moving on to the flexible budget. So flexible budget deals with data at various levels of activity, and this is essentially a series of static budget at different activity levels, right? Again, the key here is to understand that this is a very adaptable budget. It's useful because it is adaptable and it can be prepared for each budget type in the master's budget. So your sales budget, your production budget, and so on. But again, the key is that it's adaptable. That is, it's adaptable to changing conditions in the marketplace. So here's the situation here. They've given this here manufacturing overhead costs as static, and they've given us the production in units and all the different costs. So when we calculate the direct materials and the direct labor and whatnot, we have 1.1 million in cost. Okay, so note here, this is for 10,000 budgeted production, right? Well, the actual production of 12 is 12,000. So let's look at this overhead static budget report, assuming 12,000 units were actually produced rather than the 10,000 that we budgeted before, shows different results. So we budgeted 10,000 units, we produced 12,000, we budgeted 250,000 in costs, but the actual cost for direct materials was 295. So we have an unfavorable difference, right? Direct labor, same thing. 260 we budgeted, the actual cost was way more. Again, we have an unfavorable differences of 52,000 and so on. So for this here, as you can see, when we look at the static budget, right, we have an unfavorable difference of 132,000. Now, why flexible budget? Well, as you can see, over budget in the 3 months in the three of the six overhead costs was quite interesting because interesting. Why is that the case? Well, we had an unfavorable difference of 132, right? 132,000. So the budgeted data was not really, what can you say? It's not relevant, right? So the point to understand or to make, the point to make here is that it's actually meaningless to compare the actual variable costs for 12,000 units with the budgeted variable costs for 10,000 units, right? Because the variable cost increases with production. Now, flexible budget, it's widely used in production and service department. It's basically seen as a type of internal report, and it consists mainly of two sections: the production data for the selective activity index, such as direct labor hours, and your costs data for your fixed and your variable costs. As you can see here, it's also widely used to evaluate managers' performance. Thank you very much.